Hello, everyone. I'm Yiğit from Sabancı University. I want to thank you all for joining our webinar titled Investor Attention, Trading and Asset Prices. This webinar is organized by Center of Excellence in Finance under the sponsorship of Akbank. I would like to welcome Professor Terrance Odean from UC Berkeley. He's joining us right now from California, and his research and seminal work had a role in shaping my academic curiosity, so it is a personal privilege also to be hosting him today. Welcome, Professor Odean.
Thank you.
I would like to offer a couple of introductory words for you. Terrance Odean is the Rudd Family Foundation Professor of Finance at the Haas School of Business at the University of California, Berkeley. He's an advisory editor for the Financial Planning Review, a member of the Journal of Investment Consulting Editorial Advisory Board, and of the Russell Sage Behavioral Economics Roundtable. And he is also a Wall Street Journal expert panelist. In 2016, he received the James R. Burton Award from the CFA Institute for research notable for its relevance and value to investment professionals. He has been either an editor, an associate editor, or co-editor at leading academic journals such as the Review of Financial Studies, the Journal of Finance, Management Science, and Journal of Behavioral Finance. He has served as a director for UC Berkeley's Experimental Social Science Laboratory, a member of the Russell Investments Academic Advisory Board, a member of the WU Gutmann Center Academic Advisory Board at the Vienna University of Economics and Business, a visiting professor at the University of Stavanger, Norway, a chair of the Haas Finance Group, and the Willis H. Booth Professor of Finance and Banking. All in all, he's one of the leading experts in the fields of investor behavior and behavioral finance. We will have a short question and answer session after Professor Odean's talk. You can type up your questions in the chat box, and I will direct them after our guest's talk is over. And again, Professor Odean, thank you for being with us, and the floor is all yours.
Thank you. All right. I'm going to talk about investor attention today. And I also want to talk about how the world of investing has been changing. So let's see. Are my slides up?
Not yet. I think you should share them once again.
Oh,
maybe.
I need to share them.
Let's see. Yeah, right
There
right
they
now
are.
they're up.
All right.
Perfect.
There we go. Okay. So 50 years ago in the US, if you wanted to place a trade, you had to get on the phone during business hours and call your broker. If you bought 100 shares of a $10 stock, you probably would have paid about $16 or $17 in commission. There were no index funds to buy. Now, what about getting information? Well, if you were lucky enough to live in New York, you could read the Wall Street Journal every morning. Otherwise, you'd probably get your local newspaper. Local newspapers would devote a few pages in the business section to some news about companies, some about the economy, and then a list of closing prices and maybe the high and low from the previous day's market. So you had to wait for news, and there weren't that many sources. Another alternative would be to watch television in the evening. At that time, there were 3 national networks, broadcast networks in the US, each of which devoted about 5 minutes a night to news and news about the market. And finally, you could wait until Friday evening. The public PBS, Public Broadcasting Corporation, had a show every Friday evening called Wall Street Week, where Louis Rookheiser, who was the host, would invite people like Peter Lynch and John Templeton, money managers, analysts, onto his show to talk about the market and possibly make some recommendations. Today the world is very different. So as you know, today you can go on the internet anytime, any day, and find a vast amount of information. You can trade at any time, any day. You can, pick up your phone, place a trade in a matter of seconds. You can trade with 0 commissions. So a lot has changed in the technology of information and of trading. Human psychology has probably changed a little bit less. So as I say, I want to talk about attention, and people have limited attention. We can only pay attention to a small number of things at any time. So several years ago, my friend and co-author Brad Barber and I asked ourselves, how do individual investors choose the stocks that they decide to buy? And we thought, well, this is a huge search problem. There were about 5,000 stocks to choose from on the exchanges at the time, even if you limited yourself to the S&P 500 stocks. Almost nobody wants to go through a list of 500 stocks and read about each one and say, oh, I like that one better than that one better than that one. We figured that's not what investors are doing. More likely what they're doing is they are waiting for stocks to catch their attention. And when a stock catches their attention, they ask themselves, do I want to buy that? Or do I not want to buy it? So on a particular day, there might be a dozen attention-grabbing stocks, maybe stocks on the front page of the Wall Street Journal. 2 investors read the journal. One of them is a momentum investor, sees a stock that has positive earnings surprises and says, that one appeals to me, and buys it. Another investor is a Graham and Dodd style value investor. That investor reads about the same 12 stocks, but chooses a different one. So preferences and beliefs matter, but attention is the first filter. Attention takes that choice set from 500 or 5,000 stocks down to a manageable number, say a dozen. So what we thought was that attention-grabbing stocks that got the attention of individuals, for those stocks, individuals would tend to be on the buy side of the market. They would buy them. Attention doesn't matter as much for selling. And there's a few reasons for that. The main one is that most individual investors hold relatively small portfolios of individual common stocks. In the databases we've looked at, typically maybe 4 stocks in a portfolio. So if an investor owns 4 stocks and wants to sell something, he or she can easily consider each of the options. Do I want to sell A, B, C, or D? And so attention doesn't matter. Probably emotions matter more there, or in some cases, people are paying attention to taxes. But what we thought was, well, limited attention is going to affect buying more than selling. So individual investors will end up on the buy side of the market for attention-grabbing stocks. Institutions less so, and again, for several reasons. One is they have more attention. They're more likely to work in teams. They work all day. They're more likely to use computers to help them filter through the choice set. They also have there's less asymmetry between buying and selling because they have much larger portfolios. So they have a large universe from which they sell as well as buy, and hedge funds or other funds that routinely sell short, for them, the universe of stocks that they buy and sell is essentially the same. So we're not saying attention doesn't affect institutional investor behavior. In fact, my colleague Anastasia Fadik has a paper that shows that it does affect institutional investors, but not to the same degree as individuals. Okay, so what happens when a stock attracts investors' attention? Individual investor trading activity, the volume goes up. Now, that's not surprising at all. If people are paying attention to something, they're probably trading it more. You can even turn it around the other way. And we do, I'll show you in a moment, where we say, well, if trading volume has gone up, people must be paying attention to it. More importantly, individuals are on the buy side of the market. So they're placing more buy orders than sell orders. this tends to drive the price up. So it puts price pressure, especially on smaller stocks, less liquid stocks, stocks that are traded more heavily by individual investors. And quite often, if you get that boost in price from price pressure, from buying pressure, you'll get a subsequent decrease, a subsequent reversal, although not necessarily back to the pre-event level. So in the first paper we wrote about this, Brad and I used 3 proxies for attention. One I just mentioned. We said, okay, if a stock is trading abnormally high volume, more than it usually does, people must be paying attention to it. So we used high abnormal trading volume as a proxy for attention. We also said, well, if a stock went down a lot or up a lot the day before, people are probably paying attention to it. People probably pay attention to the big winners and big losers. So that was another proxy. And then if a stock is in the news more than it usually is, people are probably paying attention to it. Now, we developed a little theoretical model. And let me explain this graph because I'm going to show you a few graphs that are somewhat similar. The horizontal axis, so this is from a simulation from our theoretical model. The horizontal axis from left to right is trading volume. So on the left, we have stocks that are trading less than usual. On the right, we have stocks that are trading more than usual. The vertical axis is order imbalance. The higher you go, the more the individuals are placing buy orders rather than sell orders. So our prediction, this is just from our theoretical model, our prediction was that as abnormal trading volume, as trading volume went up, the percentage of trades or the order imbalance would go up. The percentage of trades that were buys would go up. Now, we looked at data from 3 different brokerage firms. A large discount brokerage firm with about 66,000 accounts trading common stocks. A large retail brokerage firm that it was a shorter time period, but had over 600,000 accounts trading common stocks, and a small discount brokerage firm with about 14,500 customers. At all 3 brokerage firms, we found the pattern that on days that stocks were trading abnormally high volume, individual investors were very much on the buy side of the market. In fact, as volume went up, as our abnormal trading volume went up, pretty much monotonically, the fraction of trades placed by made by the retail investors was more and more on the buy side of the market. Now, we subsequently took a look at using transactions data from the New York Stock Exchange. It also includes NASDAQ and the American Exchange. We used transactions data and used a couple of well-established algorithms to identify buyer-initiated trades by retail retail investors or institutional investors. And again, when we sorted on abnormal trading volume from left to right, we found almost linear, certainly a monotonically increasing rate of buyer-initiated trades. The percentage of buyer-initiated trades went up as abnormal trading volume went up. And for institutional investors, we did not find the same pattern. Now, and this is essentially the same analysis, but using a weekly horizon instead of a daily horizon. Okay, now if we sort stocks based on the previous day's return, and this is again from a theoretical model, we get the prediction that the individual investors will be on the buy side of the market for the previous day's big winners and big losers. So the horizontal axis is sorting on the previous day's return. The vertical axis is the same as in the previous graphs. It's this order imbalance. Here we're looking at the 3 brokerage firms, and we're finding this U-shaped pattern, particularly at the large discount brokerage firm. Here we are looking at the TAC data, the transactional data over an 18-year period. And we again are getting this U-shaped pattern for individuals, for small traders, but not for institutional traders. And this is at the weekly horizon, a very similar pattern. And finally, when we sort on abnormal news, stocks that are getting more news than they usually do on the right side and less news than usual, sorting to the left, we find the same pattern both on a daily basis and a weekly basis. Individuals are on the buy side of the market for stocks that are getting more news than usual, and actually institutions tend to be on the sell side of the market. All right, very quickly, how do people hear about what's going on in the market? Well, through the media, through news. The news may be salient, like something attention-grabbing happened. It could be important. The journalists are reporting what they think investors need to know. Sometimes it's entertaining. You gotta sell that newspaper, that magazine. So people write entertaining stories. Sometimes they take an ordinary story and they make it entertaining. There's a lot of re-reporting. A lot of stories show up in like the Wall Street Journal, and a few days later they're showing up in other news sources. I'll talk briefly about sometimes news has arbitrary cutoffs, like a top 10 list, and it can be interesting to see what happens to what would have been number 11 if the list had been longer. There's paid advertising, and there's basically PR articles. I'm not going to go through these. These are, academic references to various papers that have been written about aggregate trading volume, return reversals, and buy-sell order imbalances. Okay, I'm going to tell a story here. It's from a paper by Huberman and Regev. It was a case study, and I think it does a good job of exemplifying the type of activity by individuals and institutional investors that I'm interested in here. So back in November of 1997, Nature, the journal Nature, which is a very prestigious scientific journal, published an article that discussed a potential cure for cancer, or for various types of cancers. And in the article, they mentioned that a company, Entramed, was involved in this research and owned some of the rights to the technology. And what I'm graphing here, this graph is from Huberman and Regev's paper, and it just shows what happened to the price of Entramed from October 97 through December 1998. And you can see here, let's see if this works, right there. There's a little bit of a bump in the price when the day that the Nature article comes out, but nothing too extraordinary. What was extraordinary happened a few months later. On Sunday, May 4th, 5 months later, 1998, the New York Times published a front page article that basically restated what had been in the Nature article. And for what it's worth, the New York Times had covered this same information back in November of 1997, but it had been in a back page in a much shorter article. But now it was the Sunday edition of the New York Times on the front page talking about a potential cure for some types of cancer. And it said that Entramed owned some of the rights to this. Monday morning, the market opens up, and Entramed goes from about $12 a share up to over 50. It just shoots up through the roof, drops back down a fair amount, but settles for the day up a lot. So Entramed, it jumped up quite a bit on that news, and then kind of just stayed there and slowly drifted down. So what we do is we went back and we identified trades by retail investors, small trades, and signed them as buyer initiated and seller initiated. And the red line here is graphing the cumulative number of purchases, buy orders that were executed minus sell orders that were executed by retail investors during this period. And you can see not much went on November 28th, and things are sort of coasting around, and there are a few more buy orders and sell orders. And then the small trade buy orders shoot way up relative to the sell orders. So they go up dramatically, and then continue up for another week or so and level off. Meanwhile, the institutional trades go pretty much in the opposite direction. So when the individuals buy a lot, the institutions start selling. And the individuals, they continue, as I was saying, they continued to buy in the week or so after the article had come out. The institutions were selling. And the price drifted down slowly over time. So actually, on November 28th, there were 15 more buyer-initiated small trades than there were seller-initiated trades. And then it says here May 4th, it was actually May 5th. On Monday, there were 2,898 more buyer-initiated small trades than seller-initiated small trades. So the individual investors, they saw this news about Intramed on the front page of the New York Times, and they bought. They overwhelmingly bought. They drove the price up, and they continued to hold these stocks, the stock, and the price drifted down. And that's a story that we'll see repeats itself over and over. So I'm going to talk briefly about a few papers other people have written about the attention of individual investors. One that I quite like is on newspapers, and it talks about newspaper coverage of S&P 500 earnings announcements. And what they found is that local newspapers, and this was, of course, before everyone was reading everything on the internet, when people were reading their local newspaper in the morning, they found that if the local newspaper mentioned an earnings announcement by a firm, then locally there was more trading in that stock. Now you might say, well, maybe that's because the reporters covered that firm because they know that firm is important to their clients, to their customers, the people who live in that area. So Engelbert and Parsons went and they said, well, what if the newspaper didn't get delivered for reasons, unexpected reasons, like a blizzard? And they found that sure enough, that if the newspaper covered the earnings announcement, but a blizzard kept the weather kept the paper from being delivered, then the investors in that area didn't trade that stock any more than other stocks. While if the paper was delivered, they did. So attention seemed to drive a lot of trading. I was talking about these top 10 lists. Very briefly, this is one example. The Wall Street Journal publishes a list of mutual fund category kings, and it's a top 10 list. And Keneal and Parham took a look at inflows into funds based on where they ranked from basically 1 down to 50. And they see that if you made the top 10 list, you get substantially more flows than if you just missed it. So we already knew that mutual fund flows are very sensitive to performance, but they're also sensitive to whether that performance gets publicized. Wall Street Week. I talked a few minutes ago about there was this show, Wall Street Week. It ran for a few decades. Every Friday night, the host, Louis Rukeyser, would interview prominent mutual fund managers and analysts and other people on Wall Street. And they would occasionally make recommendations. There have been a few studies that have looked at what happened subsequent to those recommendations. And sure enough, the show was on a Friday night. Monday morning, the stocks that had been recommended opened up. They stayed up for some days and then tended to drift back down again. There was also somewhat similar. The Wall Street Journal had a column that ran for many, many years in which the Wall Street Journal would invite 4 experts. These might be money managers, mutual fund managers, analysts. And each of these experts would make a stock recommendation, a stock pick. And then the editors of the Wall Street Journal would throw darts at a list of companies on a wall and choose 4 companies at random. And then there'd be this competition, the experts versus the darts. And some months later, the Wall Street Journal would publish a follow-up column that would say, well, who had done better? Well, similar pattern to Wall Street. Week when experts made these recommendations, the stock price bumped up. There was an abnormal return, and then it drifted back down over the next several days. We take a look at what happened in terms of retail and institutional trading around these recommendations. And sure enough, we find that individual investors placed a lot more buy orders than sell orders when these recommendations came out in the Wall Street Journal. The institutional investors ignored it. This was stale news, and it was just some analyst or some money manager making a single recommendation. So the institutions ignored it. The individuals paid attention to it. They drove the price up. The price subsequently drifted down. These days, instead of watching Louis Rukeyser, who is reasonably composed and not particularly emotional, people watch Jim Cramer. There's a show, Mad Money with Jim Cramer. Jim Cramer jumps up and down. He shouts. He throws things. He's fairly exciting. He also does make some recommendations. And sure enough, when Jim Cramer makes a recommendation, the stock price tends to shoot up. Sometimes I've even seen a chart of this happening in real time, but the stock price shoots up and then drifts back down again. So you get this, and then we take a look at retail traders, and sure enough, retail traders are heavily buying after these announcements or after these recommendations by Jim Cramer, and they drive the price up and it drifts back down after a while. There was a paper that looked at Google search volume. And they found that Google search volume predicted stock return, higher stock, when there's more Google search volume for a company than there usually is. That predicted higher stock returns over the next 2 weeks and a subsequent reversal. The blue line here is basically, it's graphing the return as a function of Google search volume. And then what we are looking at in the red line is we take a look at retail order imbalance. And we find, not surprising, certainly consistent with our hypothesis, that when Google search volume is higher, individuals are more and more on the buy side of the market. And that's what we think drives prices up. And when the individuals lose interest in a particular stock that they've been buying, it drifts back down over time. All right, let's talk about how the world is changing. I have a paper that I recently wrote with some friends on Robinhood. Now, most of you, or many of you, I think, have probably heard about Robinhood. Today, by the way, is the day that Robinhood is going public. Robinhood sent me an email this morning to see if I might be interested in, I think it's probably too late to buy into their IPO, but you could buy in the aftermarket. So Robinhood has a few innovative features. One, trading is incredibly easy on Robinhood. Since I was writing a paper about Robinhood, I thought I should, experience it. So I downloaded the app, transferred money from my bank account to my Robinhood account. I thought I'd have to wait 3 days or so for the bank transfer to clear before I could start trading stocks, but I didn't have to wait. All of this took less than 5 minutes, and I could immediately start trading. So it was very easy to do. Robinhood also gave me a free stock, just sort of to get me interested. I was given this stock a few shares. It was about a $5 worth of stock. And for the next several weeks, every day, I would get a text message telling me how my free stock was doing. The first time I placed a trade, virtual confetti came dropping on my screen. It said, "Congratulations." So it felt very much like I was playing a video game and I had just won something. And then the other innovation that Robinhood has made and promoted is that they do not charge commissions. How do they make money? Well, they sell their order flow. So I think last year, Robinhood made about $680 million in payment for order flow, which means they take the trades that Robinhood investors place, and instead of sending them to the New York Stock Exchange to clear, they send them to wholesalers such as Citadel, wholesale market makers. Those market makers pay Robinhood for the opportunity to be on the opposite side of these trades. And they do so because it's profitable. They can clear a lot of trades, buy at a slightly lower price than they sell. There's extremely little risk because these retail investors don't have a lot of valuable information that the wholesaler, the market maker, has to worry about. So it's simple and exciting to trade on Robinhood. As I say, there it is. Congratulations, you just placed a trade, and the confetti falls down across your screen. In our paper, we do a couple of things. One, we provide some evidence that the app itself affects investor attention and investor trading behavior. So one way we do that is we look at Robinhood's top 10 list, or top movers list, not top 10. It's more than 10. It's 26, but their top mover list. And Robinhood displays this list of the stocks with the biggest absolute price moves that day. And a lot of other sites display lists of big movers, but they usually separate the big gainers and the biggest losers. And we find that evidence that the Robinhood traders are more influenced. They're influenced both by big gainers and losers to a greater extent than other investors who are probably just looking at gains. Robinhood environment, the environment's simple. It's really simple. There's a limited amount of information available, so it's not likely to be confusing, and it feels like a safe environment. It's easy to trade. It feels like a game. And there's also a social media component to Robinhood investors, though not directly on the Robinhood app itself. So many Robinhood investors participate in forums like Wall Street Bets on Reddit. And so they're able to communicate with each other, to describe what their theories are, to say, here's what I'm buying. So it creates something that we haven't had before, which is an opportunity for individual investors to actually directly observe or nearly directly observe what other investors are doing. So 50 years ago, you didn't know what other individual investors were doing. You could see whether the market went up, a stock price went up or down. You could see what the trading volume was, but you didn't know who was trading. Now you go to one of these websites and people will say, I'm buying this, here's why I'm buying it, and that can influence other people. So, as I mentioned, the top movers list for Robinhood, it doesn't distinguish the stocks that are on the list because they've got positive moves and negative moves, while most websites do. So we look at the buying behavior of Robinhood investors in response to being on this top mover list. And we find here the rank, let's see if I show it. This is the buying activity for the most highly ranked stock on the list. And the red is stocks that are highly ranked for big moves, but they're negative moves. And the green for big moves that are positive moves. And we don't see much difference in the buying behavior. Well, if we look at other investors who are probably looking at lists that separate the big positive and negative moves, we see a fair difference in the buying activity. They're much more likely to buy the stocks that had big positive moves. So let me see here. I'm going to the paper has lots of tables, lots of regressions. I'm going to show you a few charts, and I'm basically going to tell a story. And in the story, so I'm telling the story with anecdotes, with examples, but in the paper, we verify, we back this story up with statistics, with large numbers. The examples that I'm showing are on the extreme side, but they're consistently in the direction of what we observe. Example number one, Hertz. Last year in June, Hertz said they were declaring bankruptcy. And generally when a company declares bankruptcy, that's not so good for shareholders. But there was some discussion on one of these investor forums about Hertz and sort of an argument why it was going to go up in value. And what we're looking at here is the price of Hertz, which is the orange line, and the number of Robinhood users who own Hertz. And what you see is that in the area that's circled here, right in here, suddenly the Robinhood users went from 60,000 owning Hertz up to 160,000 owning Hertz in the course of just a couple of days. That drove the price of Hertz from about $1 up to over $6 in, again, less than a week. The Hertz price subsequently drifted back down because there was no good reason for the company stock to be worth that much. The Robinhood users quit buying, but didn't really sell. They leveled off. And we figured that while some Robinhood users who bought early probably made money, in aggregate, they lost about 43%. This is similar. It was Kodak. You see the same pattern. The Robinhood users start buying. The number of Robinhood users that own Kodak went from about 10,000 to about 130,000 over the course of, looks like 3 or 4 days. The price of Kodak shot up from around $2 to over $40 and then drifted back down. And the Robinhood users in aggregate lost about 64%. When we look at several thousand cases, we find a pattern that the stock prices tend to, when there's a herding event, for Robinhood users, when a lot of Robinhood users buy a stock, it drives the price up. The price subsequently drifts back down, usually not as far, it doesn't go all the way back to where it started. And on average, the Robinhood users lose money in these events. Although, as I say, some of them probably make money, but in aggregate, they are losing money. So this is, again, this pattern, just like we saw with Entramed back in 1998, that a stock grabs the attention of a lot of investors. They start buying. It drives the price up. Price eventually starts to head back down, not in every single case, but on average, the price subsequently drifts down, and on average, these investors lose money. So here's, and we also find that the amount of negative return subsequent to the herding event is largely proportional to how many people, how many Robinhood users bought during the herding event. And oftentimes, this is also sort of relevant that, and it's the same thing we saw with the Entramed example from 1998, that after you get this big jump in the number of Robinhood users who own a stock, and the event is basically over and the price is drifting down, the number of Robinhood users that own it continues to go up, not at the same rate, but it tends to continue to go up. They tend to continue buying in the post-herding period, which of course contributes to losses on average. All right, I'm going to, let me talk briefly about another study I've been working on. And this is getting, this is basically about investor sophistication and overconfidence. So FINRA ran a couple of surveys of many investors in the country. And in one of these surveys, they had a set of questions about financial literacy, and in another survey, questions about investment literacy. Basic, fairly basic questions. And they also asked people to rate their own financial ability and investment ability. So what we're interested in this paper is who uses margin of individual investors. What individual investors borrow money to place trades. What we have here on the left is investors, this group here is investors with cash accounts. They don't trade on margin and their account won't let them trade on margin. They have not signed a margin agreement. And what we find is that they tend to have about average investment and financial knowledge, and that they slightly underestimate their self-assessment, which is the light green, is slightly lower than what they actually know. Then we look at people who have margin accounts. So they could trade on margin. They could borrow if they wanted to, but they say they've never done so. In that group here, they have slightly higher financial and investment literacy, and they're well calibrated. They have a very good sense of what they know. Finally, we have the group that that say they've actually traded on margin, and then they tend to have lower knowledge and a much higher opinion of their knowledge. They are overconfident about their ability. So what do we find? We then look at the trading of actual investors at a discount brokerage firm, and we find that the people who use margin tend to trade much more actively and much more speculatively than other investors, and they tend to have lower returns. Here's M adjusted returns, and the FF5 plus MOM means FAMA French 5-factor model plus momentum, using either method to adjust for risk. We find that individual investors, I'm not talking about institutional investors, individual investors who use margin on average underperform other investors. So basically our finding is that individual investors who use margin tend to be overconfident about their ability, and they they perform worse. And the other thing that we find is the concentration of, this is from one other paper, but it's sort of relevant, that the concentration of trading in high attention stocks is much higher for small trades and for trades placed by people with less experience and less sophistication. So let me conclude there and then maybe answer a few questions. So in conclusion, individual investors tend to be net buyers of stocks that catch their attention. When a lot of investors buy the same stock, and I would refer to that as investor herding, their buying drives the price up. Eventually, the price usually drifts back down again. The attention of investors is driven by the media. The media has been changing. So while that may have been a newspaper or a television show 30 or 40 years ago, today it's more likely going to be something on the internet or possibly on cable TV. Or on average, the individual investors lose money on their attention-driven trading. So this isn't it's not wealth-enhancing behavior for these investors. And less wealthy, less sophisticated investors lose money more consistently. All right, that's what I had to say in terms of prepared remarks. I think we probably have a few minutes for questions if anyone has any.
Thank you, Professor Odean, first of all, for your talk. I do have a couple of questions for you. One is that you talked about the fact that retail investors make decisions that turn out to be unprofitable for them on average. And you said that this is more concentrated in individual investors with less wealth and less financial literacy. Are there any other individual characteristics that determine the extent of these behavioral biases? And linked to that, like, what is the take on the question, like, do investors learn from their mistakes over time?
Good, thank you. One characteristic that I didn't mention, or demographic, is gender. I have a paper that Brad Barber and I wrote many years ago, where we look at women and men as investors. Our hypothesis is that men will tend to be more overconfident. That hypothesis was based on, reading in the psychology literature, as well as a little bit of anecdotal observation. So our prediction was that men would trade more actively than women, and that this active trading would hurt their returns. And that's exactly what we found. The men traded about 40% more actively than women. Single men traded 60% more actively than single women. And while both men and women in our sample, which was from a large discount brokerage firm, both of them tended to underperform a buy and hold approach to investing, men underperformed by about 1 percentage point more a year than women. So there's one characteristic. Now, learning. Do people learn? Yes. Do they learn quickly? Usually, no. So I have a study with a couple of co-authors where we're fortunate to have one of my co-authors obtained the trading records for every single investor in Taiwan. And we've got, I forget, like a dozen or years or more of, we see every investor, institutional and individual, and we see every trade they make. And we have a couple of papers where we look at day traders. We look at people who are routinely placing multiple trades in the same stock on the same day. And what we find, what we're interested in, is whether people who are losing money through their day trading quit day trading faster than those who are making money. And they do, but only a little bit faster. We find people who have lost money every year for several years through day trading who continue to day trade. So do people learn? Yes. Do they learn optimally? Usually not.
Okay. Thanks for that. Another question I have is, one point you mentioned was one of the primary determinants of this investor attention is the media coverage. Like media has an impact
Yes.
on this phenomenon. Just last month, I read an article in Guardian which said that right now in US, half of the newspapers are owned by either hedge funds or private equity. So, like the media is owned by these institutional investors, which you also said that they act to the contrary of individual investors, like they act contrary to their biases. So, like, what do you think about that phenomena?
Sure. So, I guess in a way your question is there potential for market manipulation through owning the media? Yes, there is potential. Personally, my prior is that it is not going on in any systematic large way. Could it? Yes, it's illegal. And so, you know, if the SEC could show that a hedge fund pushed articles promoting a stock that they were trying to run up in price, or, you know, or trashing a stock that they had shorted for the purpose of manipulating the market, that would be, you know, illegal market manipulation. By the way, it wasn't always illegal prior in the US. Prior to the crash of 29 and Glass-Steagall and some of the laws that were passed in the early 30s, it was perfectly legal for people to form a group of that bought and sold the stock at higher and higher prices to each other while promoting news articles about how great the stock was. And they would just, they did what's called pump and dump. They would bid the price up, they'd get some news, they'd get some other investors excited, then they'd sell out their shares. And that wasn't illegal, now it is. At least in the US, you know, laws vary. And of course, there are two important things when it comes to laws around issues like insider trading. One, do you have the law on the books? And two, is it enforced? I think the US, it's an area that we do a pretty good job. I'm not perfect by any means, but there's a sense that if you were blatantly doing insider trading or blatantly doing market manipulation, you would probably get prosecuted.
One question from one of our participants, maybe like I can frame this in a more general way. So like there are these two camps in finance, like efficiency camp and the behavioral camp. Like in general, how do you see the application of behavioral finance, both like its in acceptance in the academia and also regarding the application of its findings at the investing practice level?
Okay, so when I came into finance, which was basically when I started my PhD, I had thought that I would get a PhD in psychology. And I was an undergrad. I got to know Danny Kahneman, who, you know, later won Nobel Prize and also wrote the book Thinking Fast and Slow. And I went to his house one day and he convinced me to go in finance. And he was basically saying, look, this is a field. Here's a field where the dominant theory says everybody's completely rational when it comes to money. There's an opportunity here for a little psychology. So yeah, obviously I'm on the behavioral side. One thing that I found interesting is when I wrote my dissertation, and started giving presentations. And I would talk about things such as the disposition effect, the tendency to hold on to losers and sell winners, which, by the way, runs contrary to optimal tax management. And when I talked in front of academics, there was interest, but there'd be some skepticism, and you sure you did this right? And that seems strange. And when I would talk to practitioners, they say, yeah, that's what people do. The people who are out there, especially when I would talk to financial advisors, they'd say, yeah, I've known that for years. Mm-hmm. So I think people in the industry have realized that markets weren't fully efficient and that sentiment matters, and that these issues that behavioral, that those of us on the behavioral side have been now studying for, I guess 2 or 3 decades now, but more and more so, that these things matter. My view is that behavioral finance is a tool. Rather, I know we think of it as a field, but to me, it's more like a tool, just like agency theory. It'd be nearly impossible to understand the financial crisis from 2007 through 2009 without understanding anything but principal agent theory, because a huge amount of that crisis was driven in the mortgage market by basically agents that kept passing the risk off to the next person. And so in the same way, there are phenomena in economics and in finance that are extremely difficult to understand if you firmly believe that everyone is always rational, or that only the rational players matter. So, a modified version of efficient markets doesn't necessarily say everyone's rational. They just say the prices are set by people who are. And so the other people don't matter. So I think it's important, if you want to understand what goes on in the world of economics and finance, to take in consideration that people have cognitive limitations and biases. Today I talked about limited attention. There are, which I think is I think attention is extremely important. But there are other biases that affect decision-making in systematic ways.
One final question for you, again from one of our participants. So first, he says, do you agree with the statement that day traders tend to underperform indices consistently? And if so, maybe the more important part is, what do you recommend for individual investors in terms of trading behavior? Not a stock recommendation, obviously, but behavior-wise.
All right. Generally speaking, in the US, and I have to say that the advice, like so many things in economics, it's time and place specific. So in general, in the US, I would say that people should buy and hold well-diversified, low-cost index funds. Don't try to beat the market. Basically, when you place that trade for an individual stock, or God forbid, a futures position, the person on the other side of that trade is almost certainly a professional trader in the US. That person has more experience, probably more job-specific education, certainly more experience, more resources. And if he or she, and it's probably he, but it could be she, weren't good at this job, he's going to be gone soon. So why in your spare time try to beat someone, why in your spare time try to beat someone who's a professional at their own game? Now, I say index funds, of course, your first decision has to be, if you have wealth to invest. I mean, not everyone does, but if you have wealth to invest, then how much risk can you take? To what extent do you want to be in the stock market versus something, a little safer? But once you've decided that you're putting a certain amount in the stock market, I would recommend well-diversified index funds with low costs and diversify both internationally and the U.S. In the U.S. Now, I bring up the time and place because even though I don't believe that the markets are fully efficient in the U.S., they're reasonably so. You have a lot of people studying them. There are markets where they're less developed, perhaps, and the safeguards for investors are less well enforced. And you might want to consider a not very expensive but actively managed fund, because there's so much inefficiency in the market that you want someone on your behalf to be studying the market, to look out simply looking out for fraud could save you a bunch of money. So part of the reason in the US I'm not recommending this simply because we have so many active managers doing it that you can kind of freeload off of their efforts without paying them. But there would be I was giving a talk in Beijing, it's probably 10 years ago or so now, at their equivalent of the SEC, and I had discussion with their head of research afterwards. And I said to him, you guys could use more actively managed funds, because it'd be good to have more people in the market who knew how to do a discounted cash flow analysis, who understood, how to not perfectly peg the value of a company, but at least think about it. So markets vary.
Okay. Thank you, Professor Odean, for your very, very informative talk. And thanks to all our participants for joining our webinar, organized by Sabancı University's Center of Excellence in Finance with the sponsorship of Akbank. We will share a subtitled version of this talk in our social media platforms in the upcoming days, and we hope to see you at future events. Again, it was a privilege, Professor Odean. Goodbye.
And thank you. I really appreciate the opportunity. Sorry I wasn't able to join you in Istanbul. Maybe
hopefully we'll do that in the future. Hopefully.
All right. Bye-bye.
Take care. Bye.